For our second keynote speech today, we are honored to have Nick Nash to talk about investing in Asia. Nick is the managing partner and co-founder of Asia Partners, a growth equity firm focusing on investments in technology and technology-enabled companies that are transforming Southeast Asia's economy. Prior to Asia Partners, Nick was the group president of Sea, Greater Southeast Asia's leading internet company. Nick has over a decade of experience as global growth equity investor and led the landmark initial public offering of Sea on the New York Stock Exchange. Nick was unable to join us live today, but he kindly shared with us his time earlier this week. Sam Hoik, second-year MBA student, sat down with Nick to discuss Nick's vision of Globalization 2.0 as an executive and investor in Asia. Let's welcome Nick Nash.
Good evening, everyone, and welcome to MIT's 2022 Asia Business Conference. I'd like to first welcome Nick Nash to the stage as our keynote speaker. A few words on Nick. Nick is the managing partner and co-founder of Asia Partners. Prior to Asia Partners, Nick was group president of Sea, Greater Southeast Asia, a leading internet company with a $50 billion market cap from 2014 to 2018. Nick led Sea's landmark initial public offering on the New York Stock Exchange, which raised approximately $1 billion for primary capital, in which was the largest US IPO of a company from Southeast Asia. Nick joined Sea after more than a decade with General Atlantic, most recently as the co-founder and head of General Atlantic's Southeast Asia business. Three of Nick's successful investments, while with General Atlantic, are now multi-billion-dollar NYSE publicly traded companies. Prior to GA, Mr. Nash was a management consultant with McKinsey & Company in New York. Nick received his MBA from Stanford University's Graduate School of Business, where he was an R.J. Miller Scholar, and he received his undergraduate from Harvard University in chemistry and physics. Additionally, he spent 1 year at MIT in Course 2, and please join me in welcoming Nick back to MIT for this year's Asia Business Conference. Nick, great to have you.
Thank you so much, Sam. And by the way, for the record, Mr. Nash, that's my dad. I respond to "Hey, you." Let's keep this super informal.
Well, great to have you, Nick. To begin with, this year's theme is Globalization 2.0, and you've spent a large chunk of your career in Asia and in Singapore. I'm curious, when you first came, how you found the investment ecosystem and how things have changed over the 10 plus years you spent in the region.
Well, the fact that the theme is Globalization 2.0 is both scary and positive at the same lens, because I'm an old Microsoft alum, and we tended to get things right, usually only at version 3.0. Windows 3, Internet Explorer 3, the list sort of goes on from there. So I hope globalization will get out of its beta and eventually get to version 3.0, at which point it will finally work very well. But happy to provide a current view. Maybe you could just pull on that question a bit longer. What are some of the topics that you think would be most of interest to you and your colleagues?
Yeah, absolutely. Well, as Asia Partners, a new growth equity fund in the region, one thing that's interested us is the convergence of new capital in Southeast Asia, and how that's impacted the number of startups and also the trajectory of startups in the region.
It's a great question. Let me try to preface this by saying that while a lot of ink gets spilled talking about capital, the capital that companies raise, the capital that they invest, sometimes even that they burn, to getting to different outcomes of growth, we have a pretty strong point of view that capital in some ways is very much the tail to the dog as opposed to the main attraction. One of the things that we've been struck by as you look at the growth of the very largest tech platforms all around the world is that something like 70% of the companies that ultimately became the largest software or internet companies around the world spent less than $100 million to get to break even. When we say break even, we don't just mean EBITDA or net income. We mean operating cash flow minus CapEx. The data is staggering, that really the companies that stand the test of time are highly, highly frugal in their spending. They're highly frugal in the dilution that they take. They're highly frugal in the kinds of different initiatives they launch, but they're simultaneously very creative. They make a penny go a nickel's worth all along the way. And that habit develops with them as they keep building the business. So as we talk about capital coming into Southeast Asia, to a certain extent, we view it in a bit of a double-edged sort of way. On the one hand, this is a region that has historically been capital starved. In fact, relative to China, there's a pretty significant gap in the growth equity stage as companies grow. And we'd be the first to tell you that a company cannot grow on air alone. It's definitely going to have some capital to get there. But on the flip side, that paucity, that scarcity of capital has led to some really creative entrepreneurs. I'll give you 3 examples. Very close to home for me, the company I used to co-lead called C Limited, we got to profitability with just $17 million of cumulative expenditure. Why? Because that's all the money we could raise in the early days. There wasn't a lot of supply back then. And from that very, very humble start, the business produced profitability. And today, the games part of Korea produces billions of dollars of EBITDA, much of which converts into operating cash flow less capex. Another great example is a company in our portfolio called Gudang Ada. A wonderful gentleman named Henry Stephen Song founded the business. He spent his whole life in the fast-moving consumer goods industry, handling pretty complex distribution across a country with 17,000 islands, Indonesia. And he sort of woke up one morning in his sort of late 40s, early 50s and said, I want to go build my own company, go do this in an even better way. He got to $6 billion US dollars of net merchandise value, not even gross merchandise value. And he spent less than $35 million getting there. That's an incredible ratio when you think about it. And then another company that we're very fond of and just selfishly happens to be in our portfolio as well is a company called SCI. It isn't often a household name because it doesn't necessarily directly serve the consumer. It works with brands who in turn use SCI to serve consumers through different marketplaces. But SCI has grown at over 300% a year between 2016 and 19. It's been over 100% a year since then. And they've been net income positive for the past 2 years. So we think that actually one of the most interesting conversations to have is certainly around capital, but specifically capital productivity. And a part of the world like Southeast Asia that has historically been a little capital starved has found it necessary to be extremely capital productive. And in that sense, might even have a thing or two to share with the much more sophisticated and developed Western economies that have not necessarily had to be quite as capital productive because the cost of capital and the availability of capital has been quite high.
Yeah, I was going to say something similar. You don't necessarily hear about too many startups that are net income positive in the US these days. So that's really an interesting dynamic. On your list a moment ago, I noticed a couple of big names from China, like Pinduoduo. China's been a huge success story, basically, in any way you look at it in terms of the startup and the venture world. And I'd be curious how you've seen the growth of countries within Southeast Asia, as well as the tech scene's trajectory comparing with that of China's.
It's an excellent question, Sam. And I remember back when I was getting my MBA almost 15 years ago, I had the good fortune to sort of stumble into co-running our exchange program with Tsinghua University. And I remember meeting with the trustees of our business school. We were giving them a heads up on how that exchange was going. It was considered to be sort of a useful strategic thing for our university to have that Tsinghua partnership. And I made a statement to the group which sort of fell, I don't want to say it fell on deaf ears, but people thought I was a little crazy. I said, frankly, in the next decade, we will be looking to China for leadership and managerial lessons. No country gets it all right, but every new emerging country figures a few things out that we would be well advised to study. And people thought that was sort of a little bit of a curiosity at the time, never mind the fact that we learned a ton from Japan and Korea in decades prior. And the reason I want to emphasize that is that there is a lot to learn from how entrepreneurs in China have adapted the internet to suit local needs, particularly from a retail and from a consumer services perspective. I'll start with just some basic kind of facts. China is about 10 years ahead of Southeast Asia in terms of its per capita affluence. This is what we love to say is Asia on one piece of paper. Or if you're ever going to a US shopping mall, that little map that says you are here. Well, right. If you're in Southeast Asia, you are here on the map. This is exactly where we are. About 10 years behind China. China's about a generation behind Korea. Korea is about a generation behind Japan. We often refer to this as the seniors, the juniors, the sophomores, and the freshmen. And Southeast Asia is kind of in summer school, somewhere between freshman and sophomore year. Now, when you think about that time gap, there's two things that are really interesting in terms of what we can adapt and borrow from the China mold. The first is this: when countries are going through this river over here, we call it, somewhat cheekily, the golden age. It's $3,500 to $7,000 of affluence in today's dollars, inflation adjusted. Turns out that when China went through that period and when Korea went through that period, a whole bunch of companies went public. And those companies, even more so than the ones before and after, have stood the test of time. I'll give you an example. China was in that period, roughly 2004 to 14. The companies that went public in that period, plus or minus a year, are today the majority of the tech market cap of China. Korea went through that period in our parents' business generation, yet the companies that went public in that period of time are today a majority of the tech market cap. It's not to suggest that things haven't happened since then, they sure have, but that decade was a really important period of time in terms of building companies that were built to last. As we think about what might happen in Southeast Asia, we spend a lot of time thinking about the pattern of how Chinese tech companies went public and what elements of that I think are very applicable to what might happen over here. And as you can sort of see this chart unfolding, you can start to see some broad patterns. There was an infrastructure telco wave of IPOs. Each of these little chiclets is basically an IPO over the last 25 years. Then there was a Web 1.0 generation, an e-commerce and classifieds generation, a fintech and enabling services generation, and more recently, a very mobile-centric generation, what's often called O2O, driven by Meituan's investor relations pitch. And this journey of IPOs is really interesting because it has a lot of relevance to what we think is going to happen in Southeast Asia. Just like we're 10 years behind China in our affluence on an inflation-adjusted like-for-like basis, we're just about 10 years behind China in terms of the pitter-patter of companies going public. In fact, our IPO at C was precisely 10 years behind the first e-commerce IPO out of China. And you can see similar parallels in telecommunications and others as well, with varying time delays. So the really interesting opportunity in Southeast Asia is to go figure out who will be those next IPOs. And I think about entrepreneurs that are among your classmates, Sam, at MIT, and more broadly, there's so many empty rows on this chart. You almost can't look at this and say, oh my gosh, this is like those advent calendars they sell at CVS around Christmas time. You get to open up a door day by day and pull out a chocolate. There's already a couple of companies that are clearly in the near-term window. Grab has actually already gone public since we made these pages. But if I think about sort of just the next sort of generation of companies ahead, there's a lot of opportunity to go row by row on that chart and figure out who ought to be the next public company.
Yeah, absolutely. It's definitely an exciting evolution and I think path ahead. One thing that I found really interesting in terms of, let's say, investment life cycle and sort of market readiness is this paradigm of investment in telcos and technologies. And I think you guys said when investment in technology sort of outstrips telcos, then a market really starts to be ready for exploring in terms of startups and also investing. I wonder if you'd elaborate that on that a bit more and tell sort of how you came up with that idea.
Of course, absolutely. It's a really interesting dynamic. And maybe one way to think about it is to look back at the historical data. If you think about, I'll just pull this up for you. If you think about the journey of how value was created in Southeast Asia over long, long periods of time. Let me grab it for you over here. Oh, perfect. Yeah, here it is. So if you think about the ongoing sequence of things, let me try to kind of dramatically reduce the complexity into a simple way of looking at it, which is what percent of value is coming from the telco sector and what percent of value is coming from the non-telco, sort of internet, software, semiconductor sector, and so on and so forth. And something really interesting happened in China back in 2009 and 10. That was the point at which the value of the internet sector actually exceeded, for the first time, the value of the telco sector. And this is a logarithmic y-axis, so you can see these are very meaningful differences. Back in 2005, the internet sector was a small lichen-like residue on the surface of the much bigger boulder that was the telco sector. But you can see the crossover point here, a little bit of wobbliness, and then boy, this thing takes off. And it turned out that 2020 was the year that crossover happened in Southeast Asia. And we think that this can be explained in a broader pattern of the tension in value creation between telcos and application layer companies, so to speak. It's a little bit like the tension that existed 150 years ago between the railroads and the people that were consumers of the railroads, passengers, cargo, and so on and so forth. Let me put it to you this way. If you think about how the market cap of telcos versus how the market cap of non-telcos can evolve over time, there's three broad paradigms. One is the telcos lose and the application companies win. That's a paradigm. There's another model where the telcos kind of hang on by their fingernails a little bit. Maybe they don't really grow that much in inflation adjusted terms, but they're kind of hanging on to some value, and the application companies win. And there's a third model, which has only happened in one part of the world, and I'll talk about in a second, where the telcos win. It's almost like a bizarre parallel history or an alternate universe. And there, because the telcos are succeeding and data prices are so high, in some ways they take the oxygen out of the room for entrepreneurs that want to build application level companies. And we can actually think about how different parts of the world have gone down one of these three paths. In terms of model one, it's a lot of the world's emerging markets, Eastern Europe, Latin America, India, Korea, and so on and so forth. And in each of these environments, you've seen flourishing entrepreneurial environments. It hasn't always been the best place to want to be the telco shareholder, but it's been a pretty interesting place to go build game companies and e-commerce companies in Korea, or Mercado Libre, or Globant in Latin America, or CD Projekt in Poland. Tons of companies like Flipkart, my co-founder Oliver's investment in India. That second model, interesting, tends to be countries with a very large state-owned sector in the telecom industry. And that's been most notably the case in the China paradigm and in the Middle East and African paradigm. And yes, you do see movement upwards, but you don't see a whole lot of movement leftwards either, like in those other countries. And there's only one part of the world that we know of any scale where this has happened. And unsurprisingly, it's a country that had so much entrepreneurial potential. Go back to the Sony Walkman back in the 1980s and 90s, and the VCRs and the camcorders. And there was a point of view that said, oh my gosh, Japan's going to win everything. In fact, Japan probably was the one place that discovered consumer super apps before everybody else with NTT Docomo's iMode platform. But somehow over the last 15 years, the telcos have run a really good game, and they've kind of run the tables. And as a result, Japan has probably produced far fewer startups per dollar of GDP than anyone would have hoped for.
Wow, that's a really interesting way to look at it. And so when you think about Southeast Asia, you would say Southeast Asia is moving along in that sort of first category of cargo over rails.
Well, it wasn't originally, and this is the really interesting thing, and part of why Southeast Asia has maybe been a bit under the radar screen. For our first block of time, kind of 2005 up until maybe 2012 or 13, we looked an awful lot like a Japan market. People here were investing in the telcos. They did very well. There's a large telco from Indonesia that's even publicly traded in America as an ADR, and they were the biggest ever IPO. We were just the biggest internet IPO in C's case. Something happened on roughly 2012, 13, 14, and Southeast Asia took a left turn. And to this day, we're not exactly sure what happened. Empirically it happened. We're not exactly sure why it happened. We suspect a wave of price cutting as the telcos all embraced 4G around this period of time, but we're not 100% certain. But whatever the reasons were, suddenly Southeast Asia had a chance to build something really, really meaningful. And that, I think, to a certain extent explains the success of C and Grab and Lazada and Carsome and Gudagata and Dr. Anywhere and Red Doors and so many of the really great businesses in our region.
Yeah, absolutely. It's been pretty exciting to watch these companies emerge and really flourish. And I think one of the interesting things that comes out of such success is sort of the spin-off entrepreneurs who maybe started with C Limited or Grab, spent a couple of years, learned the ropes, and then decided, they saw an opportunity to do their own thing. How have you seen sort of that generation of founders and talent emerging over the last couple of years from some of the big names that we're starting to all be familiar with, even here in the US?
It's a terrific question. And of course, the sociology of entrepreneurship is worth, years of study, because there's just so much good material there to figure out and understand. And the social graph, and of course, everyone's very familiar with the PayPal mafia and their tremendous success. In a previous generation, there was a bunch of folks called the whiz kids. They all worked for the US government, helping to win World War II. And then en masse, they went over to Motor Company and did some incredible things at Ford, and then all scattered to the four winds. So this concept of whiz kids and PayPal mafias exists in other parts of the world as well. In our part of the world, it's happened in a way that maybe is a little bit surprising from a US perspective, because you see, back 10 years ago, there were no startups of any scale in Southeast Asia. In fact, if you wanted to be in tech, you probably would go work for the telcos, or you'd go work for IBM. So actually, there are 976 IBM alums scattered across Southeast Asia that are founders, co-founders, or CEOs of companies.
Wow.
Now, this may seem surprising, but if you just roll the clock back through 25 or 30 years in American tech, the IBM founders were everywhere. They were ubiquitous. Look at the founders of SAP in Germany. They were a bunch of guys out of IBM that had done really great work, and they thought they could do it a little bit better on their own. So in a weird kind of way, that time shifting, there aren't that many IBM founders in America today, some, but not as many maybe as the Google founders or the PayPal founders. But there's a lot of them here because that was the only source of have career in tech. Likewise, the telcos, the large national telecom provider of Indonesia, has produced 700 plus alumni, and they're just all over the place. You know, everywhere you go, you throw a rock, you'll find someone that used to work there, maybe in their 20s or early 30s. But then you start to see some of the more usual suspects, the Microsoft alums, the Oracle alums, and sort of next generation software. And then finally, you know, something that I'm very, very happy to see, alums of Lazada, Sea, Grab, Gojek, Zalora, Uber, all the way down the list. And if you add up just these companies, and of course there are others as well, you're talking about almost 9,000 people who have had the single best training to be business people, which is what a really close friend of mine in the States, a guy named Chad Williams at CTS, loves to call the School of Hard Knocks. In fact, if anyone can get me like a football jersey, you know, SOHK football, oh man, I would wear that proudly every day. And these are 9,000 people that have been through the School of Hard Knocks. Because after all, you know, most startup life is one darn thing after another, daily and daily and daily. And there's two things that come out of this alumni base. Number one, they've learned to scale businesses generally with modest budgets. Some of these companies had more money than others, but in general, you know, none of these people were rolling cash out of their eyeballs. They had to make a lot do with a little. And oftentimes they do their next thing and they say, oh, we could actually be even better. There's a couple of things we actually overspent on, but I've learned that lesson. I want to figure this out. But the second thing is that it's a great place to meet co-founders and early hires. Because if you grew up in Indonesia and only in Indonesia, your social network might not include a Thai, a Vietnamese, a Filipino, a Singaporean, a Taiwanese, a Hong Kong, whatever the case may be. Guess what? If you worked at Lazada, you probably have a pretty good selection of people of different nationalities, linguistic capabilities, networks, family connections all around the region. And you get to go basically assemble an Avengers team out of your fellow senior managers or junior vice presidents at that company and go build something really special.
Yeah, that does seem like a really kind of amazing advantage, particularly in a region that has so many discrete countries, let's say different business cultures and different, I guess, appetites for startup offerings. And personally, I think that's one of the most interesting things about building and investing in the region. With companies you've backed, how do you often think about sort of that geographic and cross-border expansion?
Well,
Is there a specific stage it happens at, or, you know?
No, it's a great question. In fact, we're seeing it happening sooner than you might have thought. You know, there's a school of thought that says walk before you run, which is generally good advice. So don't launch 9 companies in 9 countries, subsidiaries simultaneously. Interestingly, though, I think there is a relatively common set of playbooks for how we see this manifesting. It's helpful to kind of take a step back for a second and just think about what's the territory, what's the ground, the topography of the battlefield, so to speak. And when you think about Southeast Asia, let's kind of apply the Pareto principle. There's many countries in the region, but there are 6 that are economically the largest. So we'll just focus on those without any disrespect to the smaller countries. And if you think about what the side of the cereal box would look like if you brought ASEAN, the cereal, home to your breakfast table, it would have protein, fat, carbohydrate, vitamins, and minerals. So these are the 5 nutrients that we think are important. And this gives you a little bit of the nutrition facts label. The problem is that it's not a uniform distribution of nutrients across the region. Indonesia's obviously got a massive domestic market, Brazil-like in its importance and its scale. Mm-hmm. And Southeast Asia, Singapore, and Malaysia have tremendous scalability. They're almost like Buenos Aires for Mercado Libre, or like Lebanon in the Middle East or Israel, or like the Netherlands, Switzerland, and England in Europe. So what do you do if this is sort of what the hillsides look like on the game board? What we tend to find happening is three approaches, two of which are very time tested. The first is you just do Indonesia. Now you might have a corporate entity in Singapore, maybe your board meetings are there, who knows, but it's basically the Indonesia strategy. And sometimes you'll supplement the technical talent in Indonesia in places like India, the way Gojek has, but it's an Indonesia for Indonesia strategy. Second strategy is you do all of them, but you do all of them typically from a headquarters in Singapore or Malaysia. Carson's in KL, but their CFO is here in Singapore. Grab was originally KL, moved to Singapore. Shopee, Garena, Lazada, all very much Singapore sort of centric. There is a third way, so to speak, and we keep our eyes very close to this because we would love to see more of this happening, which is actually a Vietnam-only strategy. And this has happened in part because of some very talented early venture capitalists that got there, some excellent founders in Vietnam. But what we tend to find happening over here is that rather than expanding beyond Vietnam, they tend to stay in Vietnam. And because of the small GDP pool, instead of being specialists in one line of business and going across all the countries, they become specialists in 9 lines of business. And they become little mini conglomerates or mini ETFs for tech. We see that a lot in Vietnam, where they've got one good thing, and before you know it, there's 8 little businesses they've got, and they're all trying to grow and kind of compete for resources. But let me just emphasize one key point. Between strategy 1, strategy 2, and strategy 3, you can start to see some initial patterns. So off the current crop of sort of large-ish companies in our region, the very largest ones are by and large strategy 2, some debate about Gojek, whether it's a 1 or a 2. And then you start to see a tail of companies that are more strategy 1, and then VNG is a bit more strategy 3. And in terms of what the venture capital community has been working on in terms of upstream investments that we have the good fortune to maybe look at in more of our Series C and D strategy Asia partners, yeah, give or take 60% by number of the upstream investments in Series A and B are going after strategy 2, regional. About a quarter are going after strategy 1, and about a 10th are going after strategy 3. Many of these would like to be more regional over time, but they tend to really borrow into their host countries, at least for the immediate future.
Very cool. Well, I think that opens up to another question I'm interested in, which is beyond the 1, 2, and 3 strategies, what does expansion to sort of Northeast Asia look like? Do you find many companies you see or have invested in are actively trying to expand to China, Japan, and South Korea?
It's a really interesting question for a couple of reasons. One is, historically, the flow has actually in some ways gone the other way. What I mean by that is in many ways, North Asia has been kind of aspirational for Southeast Asia. Let me give you an example of this. It's a very practical example. One of the most interesting categories for e-commerce and retail more broadly has been the cosmetics industry. And when you think about the cosmetics industry, actually Japan was a real leader in this through Shiseido and other brands. In fact, Shiseido in the 50s and 60s, that was a huge deal in Asia. That Japan was coming out of its post-war recovery, and it was very affluent. And just like everybody in the West learned to use chopsticks and eat sushi for the first time, and learned you probably shouldn't put an entire spoon of wasabi in your mouth all at once, a whole bunch of people in Asia were learning about Japanese cosmetics. And if you think about when Shiseido really began expanding, it was in 1958 that they launched their first out of Japan locations, retail, of course, not e-commerce back in those days, in Taiwan, Singapore, Hong Kong, then Hawaii, then the United States, then Europe, and then of course, Australia, New Zealand. And if you think about kind of that level of affluence, it's roughly $6,000, maybe $6,500 per capita in current dollars. Turns out that was just about the same level of affluence that Korea was at when K-beauty began to become a really big deal. Of course, now everybody's heard about the 10-step K-beauty process and whatnot. Ditto, by the way, for pop culture, J-pop got its origins somewhere around $30,000, $29,000 of affluence. Surprise, surprise, surprise. Korean culture became a really, really big deal in a somewhat similar band of affluence over here. Anybody that's seen Squid Game on TV Their parents probably watched Shogun, about Japan on network television 30 years earlier, and their kids probably watched the Transformers out of Japanese anime. So there's a lot of interesting reasons why things tend to go not north to south geographically, but more wealthy to less wealthy countries in terms of affluence, in terms of consumer trend. That said, one of the most interesting businesses in our portfolio is a company called SCI e-commerce. And what they basically do is and they've done this very profitably, they run stores on behalf of brands, large brands, mid-sized brands, small brands. And they say, look, we will basically handle on a turnkey basis, setting up your stores for you only on e-commerce, and a little bit of offline retail, but mostly e-commerce. So let's just say you're an Indonesian brand and you've got this really delicious Indonesian snack food. A lot of people in China would love to eat that because there's something so distinctive about that flavor that's really good. That stuff is selling, no pun intended, like hotcakes in China. Thai brands are selling well in China. And to a certain extent, maybe the deprivation of travel and tourism only increases the desire to sort of sample the cultures and traditions and flavors of other countries, on a more vicarious sort of basis. So that's actually been quite interesting. The other thing that's been very interesting is another company that we know well, I sit on the board of, called SnapAsk. They've been launching an education business from originally Hong Kong and Taiwan now up into Korea and Japan, and they've been remarkably successful. And, we all remember the old days when it was the Japanese that were teaching us math at Kumon. I'm sure, a lot of people listening to this remember that brand very well.
Yeah.
My sisters went through that for years. Now we've actually got people from the southern latitudes of Asia teaching math and science to folks in Japan, which is not to suggest that any one country is better or worse at it, but it is very exciting to see that sort of reversing in terms of just let the best product win and made the best company, serve the best number of customers. So that is a very interesting trend that we see developing over time.
Yeah, definitely. And I think that probably lines up nicely with your points around sort of the various GDP per capita levels and how appetite changes at these various points. Well, that's really cool. To take a step back from sort of the startup growth side and look, let's say, purely at the investing side, what does cross-border investing look like, for you guys around Southeast Asia and, maybe occasionally Northeast Asia, as well as, let's say, other VC funds, maybe based in Northeast Asia, now investing in Southeast Asia? Are you seeing a lot of sort of cross-pollination, or how does that space look?
Well, it's interesting. I think the first thing that we believe very strongly, and we could be wrong, but it's kind of an internal belief we have, is that investing has to be local. There are different levels of abstraction in computer science, there are different levels of abstraction in investing, but at some point, if you're going to make a direct investment in a company and work with them on their board and really be part of their journey, it really helps to be in the same jurisdiction as they are. Now, they may over time grow and scale, and maybe we'll have board members that can help them with Europe and help them with South Asia, China, and whatnot. But at the beginning, it helps to be local. So I don't want to suggest that investors coming into Southeast Asia are at a disadvantage, but I would certainly say that us going to Japan and Korea, we would be at a disadvantage, certainly ourselves. And I think the most important thing is really being very authentic and very, very close, not just to the companies, that's a given, but you have to actually have an empathy with the customers of your companies that you're investing in. And a lot of that, I think, is actually very challenging to do across borders. And it's doubly challenging when that empathy straddles socioeconomic distance. Let me give you a very practical example of this. If you look at Indonesia today, it's sort of a bellwether for Southeast Asia. It has an affluence per capita right over here, which we would say is about $4,000 per capita. Just to be historically accurate, if you were to ask, well, when did the United States have a comparable level? It would go off the chart. It would be somewhere around the Rutherford B. Hayes administration. I know that there's a bunch of very senior elder people on the boards of companies in America, but I have it on very good authority that no one was around during the Rutherford B. Hayes administration. Radical life extension notwithstanding. Maybe the telomeres will help us one day. But this is an important point. How do you understand a consumer when the world you live in is 100+ years beyond that? Now, you can do focus groups, you can go hang out, you can go meet people, but actually there's an element of actually being on the ground to understand the nuance of the consumer. Let me give you a really practical example of that. One of the most interesting topics in all of business is pricing. How do you price something? Have you ever walked into the 7-Eleven and wondered why there's so many things at $7.99? Well, that's the psychology of pricing.
Sure.
But there's also a more tactical aspect around how do you price in absolute terms. One of the industries that I think has done such a good job of this, and frankly could teach the tech industry a lot, is the fast-moving consumer goods industry. And you look at places like Indonesia and the Philippines and India, these sorts of stores at roadside aren't just common, they're ubiquitous. In Indonesia, they're called warungs. In the Philippines, they're called sari-sari stores. In India, they're called kirana stores. And I mean, literally, there's probably 1 million of these stores in India, plus or minus. There's just lots of them. And one of the things that these stores have learned, and of course the FMCG makers, the manufacturers have learned, is that you're not going to sell someone the 30-liter Pert Plus that people will buy at Costco, or the 200 cubic yard of cornflakes that will sit in just one small part of your basement if you have a big American McMansion. Quite the opposite. In fact, what sells really well are what are called sachets, like a tea bag, but a tea bag sized version. It's kind of like those little things you get on an airplane sometimes, if you ask them for like a glass of wine or something. And what comes at some environmental cost in terms of packaging material, let's be clear about that, is also very affordable, because these are small little packets and they'd rather buy 3 times a week than buy the big one and strand and sequester the family's limited working capital. Why do I talk about this for tech? Well, when you think about like how Western tech platforms are trying to grow around the world, often in markets with significantly less affluence in their home market, we love thinking about Netflix as an example, because it's such a ubiquitous brand in America. I don't know anybody in America that hasn't at one point had a Netflix subscription or didn't get the red envelopes in their mailbox. But just humor me for a second, Sam. This is how Netflix prices around the world, or at least it was as of a few months ago. We found this data online. And at first glance, we're like, this is pretty interesting. Makes total sense. India is probably the least affluent country on this chart. And it makes sense that the Netflix subscription costs about 60 cents less than the Philippines, which costs about $1.40 less than Indonesia, which costs 30 cents or whatever, 70 cents less than Thailand. And eventually you go all the way up to France, which is the 14, 15 zone. And of course, Germany, probably very prosperous. You can get away with charging $16. That makes total sense, right? It's sort of what a scientist or a mathematician would call monotonically increasing. It goes up as affluence goes up. Just humor us for a second. This isn't rocket science. Divide these numbers, which are monthly subscription prices, by monthly GDP per capita. You see where I'm going with this?
Sure.
Holy moly.
Yeah, wow.
Netflix costs 4.85% of pre-tax GDP. Holy moly. Wow. Whereas in Norway, it's a barnacle in the bottom of a Norwegian sailing boat. So this is super interesting. What it tells you is that there's certain markets where a subscription is not really a great way to price. Now, why does that matter? Okay, well, if not a subscription, then what? Well, there was a really cool innovation, which, like so many good innovations, went unheralded in 1999. It was the year that Nexon's first item-based game was launched. And what's really interesting about this is that just like Toyota and the quality production system, which actually came out of Mr. Deming's thoughts in America at NYU, the first item-based game was actually an American game called IKEA, but it didn't fly that well in America because America is north of this transition zone. North of this blue zone, in unscientific terms, you should actually price as a subscription. People would prefer that. But south of that zone, item-based makes a lot of sense. And Quiz was kind of at the tip end of that zone in 1999. Its successor, not in genre, but the same developer, MapleStory, was a huge hit. No one in America has heard of MapleStory, but it was a very big deal in Asia. It was sort of like Star Wars, actually. It was a very big deal in Asia. And guess what? It turns out that the best ways to make money in America are in subscriptions, but the best way to make money in Asia is on an item basis. So a lot of tech companies that think about cross-border investing and a lot of investors that think about cross-border investing, you sort of have to take off one hat and put a new hat on. Just say, all right, so far so good. But in these markets, should I price the same way? And can the same company have two different pricing models? If you're reluctant to fork your code, would you not be as reluctant to fork your pricing? Something to think about.
Yeah, absolutely. That makes a ton of sense. That sort of the local knowledge wins out, and that you can show up and still have a significant learning curve and end up really fishing in the wrong pond a lot of time if you're looking for different, patterns that don't really exist or sort of aren't ultimately true. And I think that leads into my next question nicely, which relates to talent a little bit. Over the last 2 years, we've had what they're now calling the Great Resignation here in the U.S., with people leaving the labor force and certainly maybe workers wanting a different type of compensation or working flexibility than they had previously. Are you seeing anything like this emerging in Southeast Asia?
Good question. I think let's talk about what is very similar. Everyone in the tech sector, in we can call the professional services or knowledge worker sector, has had to adapt to Zoom-based conditions, not really seeing their colleagues. And that's been a positive and a negative. I joke in a self-deprecating way that because of the advent of Zoom, there has never been a better time to be a overweight introvert like I am. Because no one knows how chubby you are when you're only looking at your boob above the neck. But let me tell you, man, there's a gravitational field disturbance whenever I walk into the room, which might have been a career limiting step before Zoom. But all kidding aside, I think the more important salient fact is that Zoom-based work, it does come at the cost of the social fabric and the teamwork and the camaraderie. And we have to really work very hard to make sure that that doesn't come at the cost of productivity and ultimate company cohesion. However, as a positive, it's no longer quite as necessary to work or live in the downtown area. I mean, real estate developers have long been the beneficiaries of the fact that people didn't want to have a 30-minute commute or 2-hour commute. So you could jack up the rents, for CBD space, Class A office space, shoebox apartments. If the Zoom signal is instantaneous or near instantaneous to the person who lives 30 miles away or 300 miles away, you could start to go after talent that's a bit further off. And one of our very close friends in business, and I'll leave his name out to protect the source, he mentioned that the productivity of lines of code per person per day can often be a bit lower with remote work, but you can also tap into so many more potential talents that didn't just live in the Silicon Valley region or just live in the Tokyo region or just live in the Hong Kong region, that it's actually a net positive. What it actually forces, and I'm really curious to see who solves this problem. It probably won't be any one company, but a couple people will solve it. How do you handle better project management? And look, GitHub and uploading your code and checking stuff is obviously very sensible, but can someone reinvent project management software to handle a lot more remote talent and basically make that remote talent not 30% less productive, but maybe 15% less productive than being in the office? That I think is going to be a huge opportunity over time. But all that said, look, I think the really nice thing about Southeast Asia is that because we're at a level of affluence that, again, is comparable to the Rutherford B. Hayes administration, people are looking forward more than they're looking backwards. And there's nothing more aspirational than seeing Japan just a 6-hour flight away, as successful and prosperous as it is, seeing America, a 15-hour flight away, as successful and prosperous as it is, Australia, not even that far away than either of those two. And to say, gosh, if we work really hard here, we can do that. So I want to have an open invitation to every person listening to this conversation, whether you're a Southeast Asian ancestry or not, call us, drop us an email. We would love to interview you, whether for Asia Partners or our companies. Come on down and build with us. And the scariest thing about being an MBA is this sort of sinking feeling that even if I work hard and I'm very, very professional, I'm scrupulous about all the work I do and very honest, and very pleasant to work with, somehow that other guy can become a billionaire and I'd just be stuck somewhere. And it's a real fear we MBAs have. The best way to counteract that is to go to a part of the world where GDP is growing 5 or 6% a year in real terms, because we need all the hands on deck we can get. And you know what? If you're an MBA, you're always better off going to an opportunity-rich, talent-thin region than an opportunity-poor, talent-rich region. And I won't name names until what parts of the world fall into the category, but I will tell you that we are an opportunity-rich, talent-thin region. That's a really great place to go to build your career.
Yeah, absolutely. I think that makes a ton of sense. And I think that's also a great uplifting note to end on, Nick, unless you have anything more you'd like to add.
No, Sam, other than to say that, my wife and I are huge fans of MIT and the Boston area. She got her master's in course 2. I was in course 6. Struggling student. Anyone that has those MIT teachers that say 6 hurts, I know exactly what you're talking about. I was horrible at it. But really warmly welcome, students, graduates of your program and more broadly that are in this conference to come on down. Bob Barker said it right. Come on down. The water's warm.
Great. Thanks a lot, Nick. It's been a pleasure to have you with us tonight, and we really appreciate your time and sharing your wealth of knowledge and perspective on startups, investing in Asia, and in general, how to think about next steps beyond an MBA.
You're very kind, Sam. We're just trying to figure this out one day at a time. So we don't have a wealth of knowledge. We just have a bunch of mistakes we've already made and don't want to repeat.
Yeah, gotcha. Well, thank you very much, Nick.
Great. Take good care.
You too.
A big thank you to Nick Nash. Up next, we have our VC Entrepreneurship panel, starting promptly at 6:55 p.m. Eastern Time. We'll see you back here shortly.